deadline passed on Friday, and almost no one you know heard about it. July 10, 2026. It came and went with no headline on the evening news, no letter in most mailboxes, no alert on your phone. And according to the National Taxpayer Advocate, an independent watchdog inside the IRS itself, that quiet date may have just closed the door on refunds owed to tens of millions of Americans. Money that was theirs. Money the government had, in many cases, taken in penalties and interest it may never have been entitled to charge in the first place. By the end of this video, you will understand exactly what that deadline was, where it came from, who it affected, and whether there is anything left you can do if you were one of the people it touched. And you will understand why a refund this large, owed to this many people, was allowed to expire in near silence. Here is the short version, and then we will slow down and take it apart piece by piece. During the COVID emergency, the federal government declared a national disaster. Under the tax law, a federally declared disaster is supposed to postpone certain filing and payment deadlines. A federal court, in a case called Kwong versus United States, looked at how the IRS handled those deadlines during the pandemic and concluded that the agency should have postponed them further than it did. That ruling opened a window. If your deadline should have been postponed, then the clock on claiming a refund started later too. And that later clock, for a very large group of taxpayers, ran out on July 10, 2026. Stop and think about what that means for a moment. This was not a new tax. It was not a benefit cut. It was the opposite. It was a chance to get money back that many people did not even know they were owed, and the chance to ask for it expired 3 days ago for a huge category of claims, and the vast majority of the people affected never received a clear, direct warning that the clock was running at all. The National Taxpayer Advocate, whose name is Erin Collins, put it plainly in an alert her office published this month. She said that filing a claim does not guarantee anyone gets relief, but she also warned that missing the deadline may permanently prevent taxpayers from receiving a refund to which they may ultimately be entitled. Permanently. That is the word that should stop you. Now, if you are watching this after July 10 and you are wondering whether it is already too late for you, do not turn this off, because the story is not as simple as one closed door. There is more than one deadline hidden inside this. There is more than one kind of claim, and there are questions still open that could matter to you or to someone in your family. What died on Friday was one specific window for one specific kind of refund. There may be others still standing, and there is a bigger fight in the background that is not over. But to know where you stand, you have to understand how a refund this big got buried in the first place. You have to understand the calendar, because the whole thing turns on a handful of dates, and once you see how those dates line up, you will understand not just what happened here, but something uncomfortable about how the machinery in Washington actually treats the money it takes from you. So let us go back to the beginning. Let us go back to a court case almost nobody outside of tax law has ever heard of, and the strange, quiet way it reached into the finances of ordinary people who never sat in that courtroom and never will. Start with a simple idea that the tax code has held for a long time. When a disaster is bad enough that the federal government formally declares it, people caught in that disaster are not supposed to be punished for missing tax deadlines they could not reasonably meet. The law gives the IRS the power, and in certain cases the obligation, to postpone filing and payment deadlines for those affected. That is not controversial. It is how the system is supposed to work when a hurricane flattens a county or a wildfire empties a town. Now hold that idea next to what happened in early 2020. On January 20, 2020, the federal government's disaster timeline for the pandemic began, and within weeks the entire country was under a federally declared emergency. Not one county, not one state, every state. The whole nation was, in the language of the law, a disaster area. That had almost never happened before at that scale, and it raised a question that sounds simple but turned out to be worth an enormous amount of money. If the whole country is a declared disaster, whose tax deadlines get postponed, and for how long? The IRS did postpone some deadlines during the pandemic. You may remember that the spring filing deadline in 2020 got pushed from April into July. But the argument in the Kwong case, and in the reasoning the courts examined, was that the postponement the law required went further and lasted longer than what the IRS actually granted. The tax law contains a provision that, for a federally declared disaster, adds a mandatory period on top of the emergency itself. And when you apply that mandatory period to the pandemic disaster declaration, the deadlines that should have been treated as postponed stretch out much later than the dates the IRS used when it decided who filed on time and who filed late. That is the heart of it. According to the reasoning in Kwong versus United States, a whole set of returns and payments that the IRS treated as late were not actually late. They fell inside a postponement window the law required. And if they were not late, then a great many of the penalties and the interest the IRS charged for lateness during that stretch were charged on the wrong assumption. The government collected money for a delay that, under the court's reading of the law, was not a delay at all. Sit with how strange that is. This is not a case where taxpayers found a loophole or a clever deduction. This is a case where an independent watchdog inside the IRS is telling the public that the agency may have taken money it was not owed from millions of people by using the wrong deadline. And the remedy is not automatic. The government does not simply find everyone it overcharged and send the money back. The burden, as it so often is, falls on the individual. If you were overcharged, you have to be the one to notice, to understand a court ruling you have never heard of, to fill out the right form, and to do it before a clock you were never clearly told about runs out. Let me put this in the plainest terms I can. Imagine a store overcharges you at the register because the clerk used the wrong price. In an ordinary store, you notice, you point at the receipt, and they refund the difference on the spot. Now imagine a store where the wrong price was used for millions of customers over 3 years. The store agrees the price may well have been wrong, but the only way to get your money back is for you to personally discover the error, learn the exact rule that was misapplied, fill out a specific form, and mail it in before a cutoff date the store never printed on your receipt. That is much closer to how this actually worked. The error and the refund are two completely separate events, and the second one only happens if you make it happen. And here is where the urgency comes from and why that Friday date matters so much. A refund claim in this country does not stay available forever. There is a strict window for asking, and once it closes hard. So the entire question for tens of millions of people became a question of timing. When exactly did their clock start, and when exactly did it stop? To answer that, we have to line up the dates because the dates are where the whole thing was won or lost. Let us build the calendar carefully, because everything depends on it, and because once you see it laid out, you will understand how a deadline this important stayed invisible to almost everyone it affected. Start date. The federal disaster period tied to the pandemic began on January 20, 2020. That is the front edge, end date. The related federal emergency declarations were brought to a close in the spring of 2023, with May 11, 2023 standing as the date the government used to mark the end of the emergency footing. So the disaster period, roughly speaking, runs from January 20, 2020 through May 11, 2023. More than 3 years in which the entire country sat under a federally declared disaster. Now add the piece that most people never knew existed. The tax law does not just postpone deadlines for the length of the disaster itself. For a federally declared disaster, it adds a mandatory extra period on top. When you apply that mandatory add-on period to the end of this disaster window, the deadlines that fall inside it are treated as postponed not just to May of 2023, but roughly 60 days beyond, landing on July 10, 2023. Hold on to that date. July 10, 2023. Under the reasoning in the Kwong case, that is the date a large set of pandemic-era deadlines should have been treated as due. Here is why that single date controls everything. The rule for getting a refund is one of the oldest and least forgiving rules in the tax code. To claim a credit or refund, you generally have to file your claim within the later of 2 windows. 3 years from the date you filed the return, or 2 years from the date you paid the tax. That 3-year window is the one that matters for most people here. And if your relevant deadline is treated as July 10, 2023, then your 3 years to ask for the money back runs out on July 10, 2026. There it is. That is the whole trap drawn in 3 dates. January 20, 2020, the disaster begins. July 10, 2023, the postponed deadline the court's reasoning points to. July 10, 2026, 3 years later, the day the window slams shut. The deadline that passed last Friday was not arbitrary, and it was not random. It was the mechanical result of a 3-year clock that started on a date most taxpayers never knew applied to them. And notice what this means. The very thing that created the refund, the postponement of the deadline, is the same thing that set the expiration clock ticking. The later your deadline was pushed, the later your refund window opened, but it still only stayed open for 3 years. So the people who were overcharged had a right to ask for their money back, and that right came with a fuse attached, and the fuse was quietly burning the entire time, and it burned out on July 10, 2026 for the largest category of these claims. Now, a fair question. If this window opened because of a court ruling, and the ruling and the reasoning took time to work through the system, how were ordinary people supposed to know any of this in time to act? That is exactly the right question, and the answer is the most troubling part of the whole story. Because the honest answer is that most of them were not told, not directly, not clearly, and not in time. But before we get to why the warning was so quiet, we need to look at who was standing inside that window in the first place. Who, specifically, was owed money, because it is a much larger and more ordinary group of people than you might expect. When you hear the phrase tax refund dispute, it is easy to picture someone wealthy, someone with complicated finances and a team of accountants. Put that picture down. The people standing inside this window were, in enormous numbers, ordinary working households, and in many cases the people with the least room to spare. Start with the most direct group. Anyone who filed a return or made a payment during that pandemic stretch and got hit with a penalty or interest for being late. According to the National Taxpayer Advocate's own description of who may be eligible, this includes taxpayers who were assessed penalties or interest for filing or paying during the relief period. If the court's reasoning is right and those deadlines were postponed, then those people were charged for lateness that, under the law, was not lateness. Think about who runs late on taxes in a normal year, let alone during a pandemic. People juggling a job loss, people who were sick, people caring for someone who was sick, people whose small business was hanging on by a thread. Late filers are very often the people already under the most pressure, and they are the ones who got charged. Then there is a second group that most people never think about. Taxpayers who had to file certain international information returns, the kind that carry very steep automatic penalties for being even slightly late. The advocate specifically flagged late filed international information returns as part of this. These penalties can be brutal, sometimes $10,000 or more for a single late form, and they are often assessed automatically. If those deadlines were postponed and the penalties were charged anyway, that is real money, and it hit people who were often simply confused about the timing during a chaotic period. And then there is a third group, and this is the one that reaches into the most kitchens. The advocate noted that some taxpayers may have missed out on refunds, refundable credits, withholding credits, or pandemic-era benefits for tax years 2019 through 2022. Think about what that covers. Refundable credits are the ones aimed squarely at working families and lower-income households. Withholding credits are money already taken out of paychecks. Pandemic-era benefits include the stimulus and relief payments that were meant to reach exactly the people who were struggling most. If the deadline to claim those was later than people realized because of the postponement, then this window was, for many families, the last chance to reach back and collect money that was designed for them from the start, and that they simply never received. So put those 3 groups together and look at the shape of who we are talking about. Late filers under pressure, people tangled in high penalty paperwork, and working families who missed credits and payments aimed right at them. This is not a niche. This is a cross-section of the country, weighted, if anything, toward the people who could least afford to leave money on the table. Here is the part that stings. The very circumstances that made someone likely to be overcharged during the pandemic, the job loss, the illness, the chaos, the confusion, are the same circumstances that made them least likely to be watching a tax court case in 2026 to learn they were owed a refund. The people most likely to be affected were the people least likely to hear about the fix. That is not a coincidence. It is a pattern, and it is a pattern that repeats over and over in how these things play out. Which brings us to the number. Because when you take a group this broad and this ordinary, the scale of it stops being about individuals and starts being about something much larger. And the scale here is the part that Washington has been remarkably quiet about. Let us talk about how big this actually is, and let us be careful and honest about what is known and what is not, because that honesty is the whole point of a channel like this one. The single most important figure comes straight from the National Taxpayer Advocate's office, and it is this. Tens of millions of taxpayers may be entitled to refunds or abatements of penalties and interest. Tens of millions. That is not a phrase anyone uses loosely inside the IRS. Read it slowly. This is the government's own independent watchdog, saying that the number of people who may have been owed money under this ruling is measured not in thousands, not in hundreds of thousands, but in tens of millions. Now here is where I am going to do something that most coverage will not, and tell you clearly what we do not know. We do not have a single official dollar total for how much money is at stake across all those people. The advocate's alert did not put a grand number on it, and I am not going to invent one for you, because a made-up number would be worse than no number. What we can say is grounded and specific. We know the category of money involved. Penalties for late filing and late payment. Interest charged on top of those. High-dollar international information return penalties. And missed refundable credits and benefits for tax years 2019 through 2022. Think about the arithmetic even without a headline figure. A late filing penalty can run at 5% of the unpaid tax per month, up to 25%. A late payment penalty adds more. Interest compounds on top. For a household that owed even a few $1,000s and got tagged as late during the pandemic, the penalties and interest alone could easily reach into the hundreds or thousands of dollars. Multiply a figure like that across tens of millions of people, and even if only a fraction were truly overcharged, you are looking at a sum that is enormous by any measure. This is not loose change. This is a serious pool of money, and under the court's reasoning, a large share of it may have been collected on a deadline that the law says should not have applied. And consider the international penalty group again. When a single late form can carry a $10,000 automatic penalty, it does not take many people to build a very large total. These are the penalties that can wipe out a person's savings over a paperwork timing issue. If those were assessed on postponed deadlines, the individual stakes for each affected person are severe, even if that group is smaller than the others. There is one more number worth holding in your head, and it is a number about time rather than dollars. 3 years. That is how long the window stayed open, and it sounds generous until you remember what those 3 years contained. People were recovering from the pandemic, changing jobs, moving, caring for family, burying family. A 3-year clock feels long on paper and vanishes in real life, especially when no one is reminding you it is running. The government did not have to keep this a secret to benefit from the silence. It only had to let ordinary life do what ordinary life does, which is fill up with everything except obscure tax deadlines. Time was quietly on the government's side the entire time, and time is the one asset that never sends you a reminder that it is running out. So here is the picture. A watchdog inside the government says tens of millions may be owed. The categories of money are real and in many individual cases large, and the official response has not been a national campaign to find these people and pay them back. It has been a procedure, a form, a deadline, quietly published guidance that told people they were free to come forward and ask on their own initiative before a date most of them never saw. That gap between the size of what was owed and the quietness of how it was handled is the thing worth sitting with. When Washington wants you to know about a deadline, you know. When a payment is due, when a benefit is launching, when an enrollment period opens, there are notices and campaigns and reminders. So the real question is not just what happened. The real question is why, for a refund this large owed to this many people, The message was so quiet that the deadline could pass last Friday with most of the country never hearing a word. And the answer to that is not comfortable. Here is the uncomfortable truth at the center of this story. There is a difference between technically informing the public and actually reaching them, and that difference is where tens of millions of dollars can quietly disappear. Was the information available? Yes. Technically, yes. The National Taxpayer Advocate published alerts. Her office laid out who might be eligible and how to file. Tax professionals who follow these developments closely knew about the Kwong reasoning and the July 10 window. If you were a tax lawyer or an accountant with clients who might benefit, the information was within reach. So no one can say it was hidden in the strict sense. But now ask the honest question. How does an ordinary person, a retiree in a small town, a working parent, someone who does their taxes once a year with software and never thinks about it again, how does that person find out that a court case they never heard of created a refund window that is about to close? The answer is that in almost every realistic case, they do not. They are not reading tax watchdog blogs. They are not subscribed to procedural updates from inside the IRS. They did not get a personal letter saying you may have been overcharged. Here is how to ask for it back, and here is your deadline. For most of the tens of millions who may have been affected, no such letter ever came. This is the quiet machinery of how these things work, and it is worth naming clearly, without anger but without flinching. When the government owes you money and the rules require you to come forward and ask for it within a deadline, the practical reality is that a large share of the money never gets claimed. Not because people would not want it. Everyone wants a refund they are owed. It goes unclaimed because the burden of knowing, understanding, and acting in time is placed entirely on the individual, and the individual is busy living their life and has no reason to be watching. Contrast that with how you learn about the things you owe. If you are late paying the government, you will hear about it. A notice arrives, then another. Interest accrues and it is itemized. The system is built understandably to make sure you know when money flows toward Washington. But when the flow reverses, when it is Washington that may owe you, the same energy is not there. The refund exists on paper, the procedure exists on paper, and then the clock runs and most people never look up in time. I want to be fair here, because fairness is the point. The IRS did announce, on July 1, 2026, a new option to file the relevant claim form electronically for those who have an online account with the agency, which made the process easier for people who already knew to look. That is a genuine improvement, but notice the timing. That easier option arrived 9 days before the deadline, for a claim window that had been quietly running for years. For the person who never knew the window existed, a smoother form that appears 9 days before the door closes does not help, because they were never standing at the door in the first place. So this is not a story about a single villain or a secret conspiracy. It is something more ordinary and in some ways more troubling. It is a story about how a system can technically do everything right, publish the guidance, offer the form, meet the letter of its duty, and still leave the overwhelming majority of affected people uninformed in any way that would let them act. The result is the same as if the information had been hidden. The money stays with the government. And that is exactly why the one office whose entire job is to stand up for taxpayers inside this system chose to raise its voice this month. Because it saw the deadline coming and it saw how few people knew. So let us look at exactly what that office said and what it told people to do. Because inside that warning is the practical information that still matters to you. There is an office inside the IRS whose only mission is to represent the interests of taxpayers, especially when the system is not working in their favor. It is called the Taxpayer Advocate Service, and it is led by the National Taxpayer Advocate, currently Aaron Collins. When that office issues a public alert, it is worth paying attention because it is the part of the machine designed to speak for you. This month, Collins and her office did exactly that. They published a warning that the July 10, 2026 deadline was approaching, and that it could be the last chance for a large group of taxpayers to protect a potential refund tied to the pandemic disaster postponement. The alert did the thing that the rest of the system had not done loudly enough. It said, in plain language, here is who might be affected, here is what is at stake, and here is the date you cannot miss. Collins framed the stakes carefully, and her wording matters, so let us take it as she gave it. She said that filing a claim does not guarantee relief. That is an honest and important caveat. Submitting the form does not mean the money is automatically yours. The underlying legal questions are still being worked out, and a claim is a request, not a guaranteed payout. But then she delivered the warning that gives this whole story its urgency. Missing the deadline, she said, may permanently prevent taxpayers from receiving a refund to which they may ultimately be entitled. In other words, filing protects your place in line even if the final answer is not yet known. Not filing may forfeit that place forever. That distinction is the single most useful idea in this entire video, so let me make it concrete. Think of the deadline as the closing of a ticket window for a prize that has not been fully decided yet. If you submit your ticket in time, you stay in the running, whatever the final ruling turns out to be. If you do not submit it before the window closes, you are out, regardless of whether the prize would have been yours. That is why the advocate pushed people to file what are sometimes called protective claims. A protective claim is a way of formally saying, I am asserting my right to this refund now, before the deadline, to preserve it, even though the legal dust has not fully settled. The office also pointed people to the specific mechanics. For claims about penalties and interest, the form is Form 843, the claim for refund and request for abatement. The guidance suggested that people identify their claim as related to the Kwong case, writing a reference to Kwong versus United States on the submission, so the IRS could recognize what it was about. For issues involving income, deductions, or credits on a return, an amended return, the form known as the 1040X, may be the right path instead. And as we noted, the IRS added an electronic filing option for the penalty and interest claims for those with an online account, announced on July 1, 2026. So the advocate did its job. It saw the quiet deadline, understood how few people knew, and rang the bell as loudly as one office inside a vast agency can. But here is the hard reality. That bell rang mostly in the places tax professionals listen, and it rang close to the deadline. For the person watching this now, after July 10 has already passed, the pressing question is different. It is not what should I have done. It is what, if anything, can I still do? And that is where we have to be both careful and precise. Now to the question that matters most to you personally, especially if you are watching after that Friday deadline. What can you actually do now? I am going to walk through this carefully, and I am going to be honest about the limits, because false hope is not a kindness and neither is false despair. First, understand what specifically closed. The July 10, 2026 date was the 3-year window for a large category of these claims, the ones tied to deadlines treated as due on July 10, 2023. For that specific category, the standard window to file a refund claim has, by the calendar, closed. That is the plain reality, and I am not going to pretend otherwise. But here is why you should not assume you are automatically out. The refund rule, remember, is the later of two windows, 3 years from filing or 2 years from payment. Those two clocks do not always run together. If you paid a particular penalty or a particular amount of tax more recently, the 2-year from payment window could still be open even though the 3-year window has closed. Timing is everything, and the timing is individual. Two people affected by the same ruling can be in completely different positions depending on when they actually paid. So the fact that the headline deadline has passed does not, by itself, tell you that every door is shut for your specific situation. Second, understand that the type of claim matters. Penalty and interest claims go on one path, Form 843. Claims involving income, credits, or amounts reported on your return may go on another, an amended return. These can carry their own timing considerations. Someone considering this would want to look at each potential claim on its own, rather than assuming a single deadline governs all of them. Third, and I want to be very careful with my language here because of what this channel is and is not. I'm not telling you what to do. I am telling you what some people in this situation are considering. Some people who believe they were overcharged are gathering their records from the pandemic years, their notices showing penalties and interest, their filing and payment dates. so they can see clearly where their personal clocks stand. Some are looking specifically at whether the 2-year from payment window still applies to them. And many are choosing to talk to a qualified tax professional rather than trying to interpret a court ruling and a set of overlapping deadlines on their own, because the stakes and the complexity are both high. There is a practical starting point that costs nothing and that anyone can do, and it is simply to gather the paper. Pull the tax records from 2019 through 2022. Look for any IRS notice that shows a penalty or interest charge tied to filing or paying late. Note the date you filed, the date you paid, and the amount of any penalty or interest. You are not making any decision by doing this. You are just building the picture of where your own clocks stand, because until you have those dates in front of you, no one, not you and not a professional, can tell you whether a window is open or closed for your specific situation. The people who tend to come out of these episodes with money in hand are almost always the ones who did this unglamorous step first, before the deadline pressure ever arrived. Let me also say clearly what filing does and does not do, echoing the advocate. Submitting a claim is a request. It preserves your position. It does not guarantee that the money comes back, because the underlying legal questions can still go different ways. But a claim not filed inside an open window is a claim that generally cannot be revived later. So for anyone who still has an open window under the 2-year rule, the decision in front of them is essentially whether to preserve a possibility or let it lapse. And if it turns out that every window for your situation has genuinely closed, there is still a reason to understand all of this, and it is not just regret. Because the forces that produce this outcome, the quiet deadline, the burden placed entirely on you, the refund that expires in silence, are not unique to this one case. They are how a great deal of this works. Understanding this episode clearly is how you get faster at spotting the next one while its window is still open. And that is worth more than any single refund, because there is always a next one. Which raises the larger question sitting underneath this entire story. What does it actually tell us that a refund owed to tens of millions could expire this quietly? Because the answer is not really about one court case. It is about the relationship between you and the system that holds your money. Step back from the forms and the dates for a moment and look at the shape of what happened here, because the shape is the real lesson, and it will outlast this particular deadline. A court concluded that the government may have charged people for being late when, under the law, they were not late. The people affected numbered in the tens of millions, by the government's own watchdog's estimate. And the remedy was not the government finding those people and correcting its own error. The remedy was a procedure that required each individual to somehow learn about an obscure court case, understand a tangle of deadlines, fill out the right form, and do it before a clock they were never clearly told about expired. When you say it in one breath like that, the imbalance is hard to miss. Now, I want to be measured here, because the point of this channel is to inform you, not to inflame you. There are real reasons the system works this way. Deadlines for refund claims exist for a reason. The government cannot leave every question open forever, and some finality is necessary for any tax system to function. The IRS is a vast agency handling an almost unimaginable volume of returns, and it genuinely did publish guidance and did offer a filing option. None of this requires believing in a deliberate scheme to cheat anyone. You can explain every individual step as reasonable and still end up with a result that should bother you. And that is exactly the thing worth naming. The result. Because whatever the intentions, the outcome was that a large sum of money that may have belonged to ordinary people stayed with the government, not because anyone decided the people were not owed it, but because the burden of claiming it was placed entirely on individuals who mostly never knew. The system defaulted in the government's favor. When there was doubt, when there was complexity, when there was a deadline, the quiet default was that the money stayed put unless you fought to get it back in time. Ask yourself how often that default runs the other way. When you owe the government, does the doubt ever quietly resolve in your favor? Does a payment you owe ever expire in silence because you were not told clearly enough? You already know the answer. The machinery is attentive and energetic when money flows toward Washington, and comparatively quiet when it should flow back to you. That asymmetry is not a conspiracy. It is just the natural tilt of a system, and the tilt is the thing you have to learn to see. This is why understanding these stories matters even when a particular deadline has passed. Not to make you cynical, and not to make you angry for its own sake, but to make you alert. The single most valuable habit you can take from this is the habit of assuming that when a rule changes, when a court rules, when a policy shifts, there may be money or a right attached to it that will not come find you. You have to go find it, and there is usually a clock. The people who do well in this system are not the ones with the most money. They are the ones who look up in time. And notice how little it actually takes to be one of the people who looks up in time. It is not wealth. It is not a team of advisors. It is not even deep knowledge of the tax code. It is a single reflex applied at the right moment. When a rule changes, you pause and you ask one question. Is there money or a right in this for me, and is there a clock on it? That reflex is available to absolutely everyone, and it is very nearly the whole difference between the people who collect what they are owed and the people who read about it afterward. That habit, the habit of looking up, is the entire practical takeaway. So let us turn it toward the future, because this story is not actually finished. There are threads still hanging, and knowing what to watch for is how you make sure the next window does not close on you the way this one closed on so many. So where does this go from here, and what should you keep your eye on? A few things, and each one could matter. First, watch the underlying legal questions, because they are not fully settled. The advocate herself was careful to say that filing a claim does not guarantee relief, which is a signal that the final answers about who ultimately gets money back are still being worked out. That means there could be further guidance from the IRS, further court developments, or clarifications about how these claims will be handled. If you filed a protective claim before the deadline, developments in these questions are what will determine whether that claim turns into an actual refund. Keep the records of anything you filed, and keep watching for official updates from the IRS and the Taxpayer Advocate Service. Second, watch the second clock. We talked about how the refund rule is the later of 3 years from filing or 2 years from payment. For some people, the 2-year from payment window may still be open even now. If you believe you were overcharged during the pandemic years, the date you actually paid a penalty or a tax is worth pinning down, because it may tell you that a door you assumed was closed is in fact still open for a little longer. This is individual, and it is exactly the kind of thing worth reviewing with a qualified professional rather than guessing at. Third, watch for the pattern to repeat, because it will. This episode, a right or a refund created by a change in the rules, with the burden of claiming it placed on the individual and a quiet deadline attached, is not a one-time event. It is a recurring shape. New rules, court decisions, and policy shifts regularly create windows like this, and they regularly close without most people noticing. The single best thing you can do is build the habit we talked about. When you hear that a major rule has changed, ask whether there is money or a right attached and whether there is a deadline to claim it. Ask early, while the window is still open, not after it is closed. And finally, watch your own mailbox and your own records more closely than you have been. A great deal of what protects people in situations like this comes down to noticing. Noticing a notice, keeping the paperwork, marking the date. The people who miss out are almost never the people who did something wrong. They are the people who simply were not watching when it counted, through no fault of their own, because no one made sure they were. If there is one sentence to carry out of all of this, it is this. In this system, the money that is owed to you does not always come looking for you, and it often arrives with a clock attached. Your job is to look up in time. Do that, and you will catch the next window while it is still open, whatever it turns out to be. Before we close, the important part. This video is for informational purposes only and does not constitute financial, legal, or tax advice. Laws and policies change. Always consult a qualified professional before making any financial decisions. What we covered here is a general explanation of a complex and still developing situation, and your own circumstances, especially your specific dates and amounts, are what actually determine where you stand. Take this as a reason to look carefully at your own records, and, if it applies to you, to get real advice from someone qualified to give it. The deadline that passed on Friday closed one door for many people. The habit of looking up in time is what keeps the next door from closing on you too.